Ladies and gentlemen, have you ever felt that quiet tension in the markets right before something big happens? That's exactly where we are right now with silver. For months, analysts have been watching it move sideways, consolidating under heavy pressure while retail and institutional buyers quietly accumulate in the background. But as we approach December, the data is beginning to tell a very different story. One that points to an explosive breakout that could redefine silver's position in the global financial system. The setup has been building for some time. Silver has been trading within a compressed range, creating one of the tightest volatility windows in years. Historically, when silver reaches this kind of compression where traders grow complacent and volatility dries up, it's often the calm before a major surge. And the timing couldn't be more aligned with a series of catalysts converging this December. Supply shortages are deepening. Industrial demand from solar and green technology continues to ramp up. Global mints are reporting record orders for physical silver. The foundation of this rally isn't speculation, it's structural. What's particularly interesting is how silver is behaving relative to gold. The gold to silver ratio remains abnormally high, hovering around levels that have traditionally preceded powerful silver rallies. When that ratio begins to narrow, it usually signals silver is about to outperform gold significantly. Investors watching this ratio are starting to position themselves accordingly, anticipating a move that could be both swift and dramatic. But the real force behind December's potential explosion lies in the macroeconomic backdrop. Central banks are stuck in a corner, tightening just enough to fight inflation, but risking financial instability with every rate decision. The cracks are starting to show in credit markets, sovereign debt, and even the US Treasury market. Liquidity is drying up and the flight to hard assets is intensifying. Gold has already started responding, but silver, often the last to move, tends to follow with a vengeance once the broader trend becomes undeniable. We're also witnessing a subtle yet powerful shift in investor psychology. For years, silver was seen as a secondary metal, a kind of gold shadow. That narrative is changing fast with the world accelerating toward electrification, renewable infrastructure, and digital currencies. Silver's dual role as both a monetary and industrial asset has never been more critical. The balance between industrial consumption and investment demand is reaching a breaking point. Physical silver inventories are depleting at a pace that's becoming unsustainable, and the market simply isn't ready for what happens when that shortage becomes impossible to ignore. Even large-scale buyers, sovereign wealth funds, private institutions, and high-net-worth investors are beginning to allocate into silver as a defensive play against currency devaluation and systemic risk. It's no longer just retail stackers or small investors driving demand. The smart money is moving quietly, decisively, and that's often the strongest signal of all. As we approach December, the confluence of technical pressure, industrial necessity, and macroeconomic instability creates a setup that's simply too powerful to overlook. This isn't about hype. It's about recognizing a pattern we've seen many times before in market history. Long periods of suppression followed by violent revaluations. Silver doesn't rise gradually. When it breaks, it surges, often catching even experienced traders off guard as we move into the final stretch of the year. Pay close attention. Watch the ratio of the volume spikes, the futures positioning, and the global headlines that hint at liquidity strain, because when these forces align and it looks like they're about to the move could be historic. Silver has been patient for years, and patience in the market is often the most powerful signal of all. December may be the month when that patience finally pays off in a way we haven't seen in decades. Major mining operations across the globe are confronting a challenge that has been quietly building for years, but is now reaching a critical juncture, declining ore grades. This phenomenon, while subtle on a year-to-year basis, has a compounding effect on silver production cost and ultimately supply availability or grade, is the concentration of silver within mined rock. And over the last 2 decades, the average grade of many primary silver and polyallic deposits has been steadily falling. Mining companies have been forced to process larger volumes of ore just to maintain the same output levels, which increases operational costs, energy consumption, and environmental impact. As a result, even if mining output remains technically stable in terms of tonnage, the actual silver yield per ton has been declining, putting pressure on overall global supply. This decline in ore quality is not uniform, but is concentrated in some of the largest producing regions, including Mexico, Peru, and China. Mexico, which accounts for a significant portion of the world's silver production, has seen several of its historic mines approach the end of their high-grade zones. In many cases, miners are now forced to dig deeper or shift to satellite deposits, which often contain lower concentrations of silver. The deeper operations also introduce logistical complexities, from increased ventilation requirements to more robust structural support, further inflating costs. Peru, another heavyweight in silver production, is dealing with similar challenges. Some of the nation's largest mines, which once delivered richer bodies, are now facing diminishing returns. Even small changes in our grade can have substantial implications for global supply. As Peru contributes millions of ounces of silver annually to the market, China, the world's third largest producer, is also navigating declining grades, particularly in older mines where high-grade veins have been extensively exploited over decades. These mines are now entering what geologists call the tailing phase, where the remaining material is less concentrated and harder to extract efficiently. Tailings in lower grade rock require more intensive processing, which increases energy use, chemical inputs, and labor costs, all of which feed into the final cost of silver production when combined across multiple regions. These factors indicate that silver supply growth is slowing just as demand pressures are set to accelerate. Added to the challenge is the difficulty in bringing new mining projects online. Exploration and development of new silver deposits are expensive, time-consuming, and increasingly constrained by environmental regulations. Permitting delays, community opposition, and stricter environmental standards can extend project timelines by years, meaning that even discoveries today might not reach production until well into the future. Historically, the silver market has relied on a balance between production from mature mines and the ramp-up of new projects to meet rising demand. That balance is now under threat as fewer high-quality deposits are being discovered and developed, and the existing infrastructure is aging. The supply squeeze is compounded by the economics of silver mining itself. With declining ore grades, production costs per ounce increase significantly. Miners are often forced to make difficult decisions, invest heavily in more expensive extraction methods, accept lower margins, or scale back production. This creates a scenario where the market may not be able to respond quickly to rising demand because increasing output is neither easy nor cheap. The price of silver itself becomes a reflection of these constraints, as the market must adjust to the realities of limited, harder to access supply. Industrial demand further intensifies the pressure on silver supply. Silver is not just a precious metal, it's a critical component in technologies driving the global energy transition. Photovoltaic panels, electric vehicles, 5G infrastructure, and various medical applications rely on silver's conductive and antimicrobial properties. Each new application compounds the demand side of the market, while the supply side struggles with declining ore grades. The result is a growing structural deficit that is not easily remedied by temporary market adjustments or speculative buying alone. Moreover, mining companies are increasingly aware of the long-term implications of declining ore grades. Many are investing in advanced extraction and processing technologies such as hydromedical techniques, automation, and driven exploration tools. While these innovations improve efficiency, they also add layers of cost and complexity. The transition to more technologically intensive mining operations is necessary to sustain output, but is not a simple solution that can instantly replace the ounces lost to declining ore grades. Even with these advancements, physical limitations of geology and the scarcity of high-grade deposits remain binding constraints. Environmental and social considerations are also intensifying. Modern mining projects must adhere to rigorous standards for water usage, tailings management, and community engagement. In regions where ore grades are declining, operations often need to process more rock and generate more waste, which raises the environmental footprint of production. Regulators in local communities are increasingly scrutinizing these impacts, sometimes halting or delaying operations that fail to meet strict sustainability criteria. This adds an additional layer of uncertainty to future supply projections, reinforcing the notion that silver production cannot simply scale up in response to market demand without consequence. Another key dimension is geopolitical risk. Major silver producing regions are not immune to political instability, labor strikes, or regulatory shifts that can affect mining output. Countries with significant silver reserves, such as Mexico and Peru, periodically face labor disputes or policy changes that disrupt production. Combined with the technical challenges of declining or grades, these factors create a scenario in which the global silver supply is highly sensitive to both natural and human variables. Even modest disruptions in major producing countries can have outsized effects on the market, particularly when demand is rising concurrently. Investors and market participants are beginning to recognize the implications of these trends. Institutional buyers, including ETFs, mining funds, and strategic reserves, are factoring in the structural supply constraints when assessing silver's future potential. Unlike cyclical price fluctuations driven by short-term market sentiment, these supply-side dynamics suggest a more enduring foundation for higher prices. Physical demand for silver is unlikely to diminish. And if supply continues to struggle under the weight of declining or grades, the market is likely to experience sustained upward pressure. In addition, the financing landscape for mining projects is shifting. As our grades decline and production costs rise, securing capital for new development becomes more challenging. Lenders and investors demand higher returns and lower risk, which constrains the ability of mining companies to expand operations quickly. This dynamic further limits the potential for rapid increases in silver supply, reinforcing the idea that structural deficits could persist well into the coming year. The decline in ore grades also has implications for recycling and secondary supply as primary production becomes more costly and less abundant. Attention naturally shifts to silver recovered from industrial scrap and old jewelry. While recycling can supplement supply, it is limited in scale and cannot fully offset the shortfall created by declining grades. Additionally, recycled silver often comes with impurities or requires reprocessing, which adds to cost and complexity. The net effect is that both primary and secondary supply channels are under pressure simultaneously. Technological trends in mining may partially offset these pressures, but they cannot fully compensate for geological realities. Advanced or sorting technologies, remote sensing, and precision extraction methods improve recovery rates and efficiency, yet they cannot create new silver where none exists. Mining companies are innovating, but the fundamental constraint of declining ore quality remains a structural challenge. The long-term consequence is a market that is more sensitive to shocks, with price volatility likely increasing as supply struggles to keep pace with industrial investment and retail demand. The outlook for silver supply in 2026 and beyond is therefore increasingly defined by this intersection of geology, economics, technology, and policy. Declining ore grade set the stage for a scenario in which the market could experience significant deficits, driving upward pressure on prices, intensifying competition for physical silver. For investors, understanding these dynamics is crucial, as traditional assumptions about readily available supply may no longer hold. Silver's historical patterns of periodic scarcity and subsequent price spikes provide a valuable precedent, suggesting that markets may react sharply once the gap between supply and demand becomes undeniable. Global consumption trends reinforce this concern. Demand from industrial sectors, particularly renewable energy and electronics, is projected to continue its steep trajectory. Photovoltaic installations require more silver each year. Electric vehicle adoption is accelerating, and emerging technologies like silver-based batteries and medical applications are expanding the metal's industrial footprint. The combination of rising demand and constrained supply creates a perfect storm for a structural market imbalance. Additionally, the investment community is increasingly aware of the limitations of mine output. Physical silver purchases, whether through ETFs, bullion, or coins, are climbing as investors hedge against currency volatility, inflation, and systemic financial risk. This growing investment demand coincides with the period when supply growth is slowing due to declining ore grades, reinforcing the upward pressure on prices. Markets are beginning to price in these realities, and historical precedents suggest that such structural pressures can lead to rapid and sustained rallies once they are recognized by a critical mass of participants. Energy and operational costs amplify the challenge. Further extracting silver from lower grade ores requires more electricity, fuel, and water per ounce of silver produced. Global energy volatility, whether due to geopolitical tensions, inflationary pressures, or supply chain disruptions, increases production costs even further. The combination of declining ore grades and rising operational expenses constrains profit margins for miners and makes expanding production less economically attractive. Finally, declining ore grades have long-term strategic implications. Silver is not only a financial asset, but also a critical component of technological and industrial infrastructure. Countries and corporations that rely on silver for industrial purposes may find themselves competing for increasingly scarce resources. This dynamic introduces additional risk to global supply chains and positions silver as a highly strategic metal in the context of both economic and technological security. The confluence of declining ore grades, rising production costs, technological limitations, regulatory pressures, and intensifying demand sets the stage for severe supply squeeze in 2020. Understand these structural constraints are positioning themselves accordingly, recognizing that the silver market is on the cusp of a transformative period. Physical inventories, production forecasts, and investment demand must all be viewed through the lens of these supply-side challenges, as the interplay between geology, economics, and technology will increasingly dictate market behavior. And the implications for pricing volatility and strategic positioning are profound. The upcoming liquidity crunch in global markets is shaping up to be one of the most significant catalysts for silver demand in recent history across multiple regions. Financial institutions are showing signs of strain as debt levels remain elevated. Central banks tighten monetary policies and credit conditions become increasingly constrained. Liquidity, the lifeblood of markets, is starting to tighten. And when liquidity becomes scarce, investors naturally seek safe haven, assets that hold intrinsic value and are resistant to systemic shocks. Silver, with its dual role as both an industrial metal and a store of value, stands at the forefront of this potential flight. The dynamics of liquidity are critical here. In recent years, global markets have been heavily supported by expansive monetary policies, ultra-low interest rates, and large-scale asset purchases by central banks. These measures have provided abundant liquidity, enabling speculative flows, debt refinancing, and leveraged investments to thrive. However, that era is now fading. Central banks are reducing balance sheets. Interest rates are rising in several major economies, and the cost of capital is increasing as liquidity tightens. Assets that are highly leveraged or dependent on cheap financing become more vulnerable. This vulnerability often triggers sudden relocations into tangible, reliable assets, and silver is a prime candidate. Investors are particularly aware of silver's historical performance during periods of liquidity stress. While gold is traditionally the go-to hedge, silver offers both defensive and strategic advantages. Its smaller market size relative to gold allows for sharper price movements during demand surges, meaning that a liquidity-driven rush into silver could result in rapid price appreciation. At the same time, silver's industrial applications ensure that its value is supported not just by speculation, but by ongoing demand from sectors like electronics, photovoltaics, and medical technology. This combination makes it uniquely positioned to absorb inflows during a liquidity crunch. As investors seek assets that are both tangible and resilient, the signals are already emerging in market behavior. Treasury yields, credit spreads, and interbank lending rates are showing early signs of stress, reflecting tightening liquidity conditions. Equity markets are experiencing bouts of volatility with sharp swings, reflecting sudden reassessments of risk. In such an environment, investors often rotate capital from paper assets into tangible commodities. Silver, with its lower price point relative to gold, is particularly attractive to retail and institutional buyers alike, offering exposure to a precious metal hedge without the same capital commitment required for gold. Additionally, global macroeconomic pressures reinforce this trend. Inflation remains a persistent concern in many economies, and the purchasing power of fiat currencies is under scrutiny. During liquidity crunches, central banks may find themselves constrained in their ability to inject sufficient support, amplifying fears of asset devaluation. Investors, both large and small, tend to respond by increasing allocations to physical assets, with silver benefiting from its dual appeal as both a financial hedge and an industrial necessity. The implications of a liquidity-driven silver rally are profound. Unlike speculative bubbles fueled solely by sentiment, this type of movement is grounded in structural realities. Tightening liquidity, rising systemic risk, and growing macroeconomic uncertainty create conditions in which investors are compelled to preserve wealth in assets that cannot be printed or devalued at will. Silver scarcity relative to demand magnifies its sensitivity to these dynamics, and the market is primed to respond decisively as liquidity pressures intensify. Geopolitical considerations further amplify the urgency of this flight to hard assets. Trade tensions, fiscal instability, and sovereign debt concerns are adding layers of risk to the global financial system. As these pressures mount, confidence in paper assets can erode quickly and physical metals become an increasingly attractive refuge. Silver's smaller, more nimble market allows it to react more sharply to these shifts compared to gold, creating opportunities for strategic positioning. The interplay between tightening liquidity and investor behavior is creating a feedback loop. As more capital moves into silver, price signals attract additional buyers, including those who may have previously relied on other hedges. This momentum effect, combined with the physical constraints on silver supply, can accelerate upward price movement, reinforcing the narrative of a liquidity-driven surge. In this context, the potential for a pronounced and rapid rally in silver becomes not just plausible, but increasingly likely as market participants seek security value and exposure to a tangible asset that can withstand the strains of a tightening global financial environment.